What's going on, everyone? So, to better understand 803 and 010, kind of dug into the past a little bit. I found an interesting article that talks about the old stock borrow program. So, I looked into the old stock borrow program, and sure enough, in 2013, they actually discontinued this. They said it was because it was not being used. As far as daily amounts they were looking at, I think it was around 1 billion or so. So nothing like what we've seen today. So as of right now, according to the new proposal for a securities financing transactions, it's 150 billion per day. So we've gone up substantially. So right here, 150 billion. And it's interesting because this old program that was discontinued in 2013, there was a loophole identified in this program by this article here that basically allowed for the creation of counterfeit shares and or naked shorting. So it's interesting how this one specifically says that they're trying to avoid naked shorts, uh, failure to delivers, and make delivery on short sales, when this one clearly had a loophole that was available to do those things. So the old system was on a T+2 basis, and it was a stock borrow program, so different than a securities financing transaction. That's more like a repo. So we're going to be on an overnight basis, and I believe the settlement's going to be T+1 on the new one. I haven't seen any language as far as settlement time specifically, but it sounds to me like it's going to be T+1 as far as the transactions occur, because they are overnight. So if you look and read this article, I'll link this below. It says that one key problem in the old program is that the NSCC system did not differentiate between counterfeit shares and real shares. Well, that's one huge difference in the new one, because we have fire sale risk mitigation as well as liquidity drain. And it identifies in here that the primary risk of fire sales relates to the reinvestment of cash collateral by institutional firms that are the lenders in securities lending transactions. Those institutional firms will typically reinvest the cash collateral they receive from the borrower into other securities. So they're repledging the cash collateral into other securities and or rehypothecation. And then it clearly says, if the borrower of those securities thereafter defaults, the institutional firm lenders generally need to quickly liquidate the securities representing the investment in order to raise cash to purchase the originally lent security. And it then goes on to say that a substantial number of those happening all at once can create a fire sale condition, which would harm the entire market, basically. So I'll link this below. Just as far as this new one, a lot less loopholes. They're tightening the loopholes because, again, I didn't even know this, but there was an old one, an old stock borrow program in 2013 that was highly manipulated, apparently. So, anywho, y'all have a good one.